Thank you so much for the opportunity to share my work with you guys. Hopefully you guys are still awake and interested in the topic that I'll be discussing. So luckily, I had Udi Hoytesh present his work before me, and I'm going to be able to leverage on some of the things that he discussed to keep mine under 7 minutes and 46 seconds. So my name is Ronen Galore. I'm an assistant professor with the accounting group. And just to briefly talk about my research interests in general, before talking about the specific paper that I'm going to be talking about, is the things that I'm interested in are first the economics of the audit industry, especially as it relates to the role of regulatory intervention, and also non-audit services. So non-audit services are auditors also providing services other than auditing, such as consulting and tax services, which have been regulated recently, and there's some interesting research to come out of that. The next thing that I'm interested in is the role of the audit committee, so governance. So the role of the audit committee is in charge of, they're basically the conduit between the auditor and management. They're supposed to be independent, make sure that they inform management if they have any questions about the audit, about the accounting, and maintain a relationship with the auditor, decide how much to pay the auditor, decide what the auditor should do. So unrelated to the paper that I'm talking about today, I also have worked in shareholder elections and seeing whether shareholder votes influence the performance of the audit committee. So the paper that I'll present today is the confluence of these first two research areas, the economics of the audit industry and the role of the audit committee. So we are accountants, so we're not particularly creative, so you probably saw this clip art from before, and so in every context, including PowerPoint, we don't diverge from what's available to us. So the paper that I'll be presenting today is called The Influence of the Audit Committee on Auditor-Provided Tax Planning Services. So in case you can't tell, this is the auditor on this side, and this is the tax provider who's stamping the pencil down. So a little bit of background on this paper is, throughout the past couple decades, there have been regulators that have called for the separation of audit and all other services, consulting services, internal audit services, tax services. So it usually comes about during either boom periods where there's a lot of consulting or other services that are being provided, or during a bust period, during a recession, and especially during recessions that are accompanied by accounting frauds. So the big accounting fraud, Enron and WorldCom, led to the Sarbanes-Oxley Act. So the Sarbanes-Oxley Act had two particular provisions that are important for my study here. The first one is that it prohibited and outlawed audit firms from providing a lot of different types of non-audit services to their clients, to the same client. So consulting services are gone, internal audit services are gone, but they allowed, there was some discussions between the business community and the regulators, and they allowed tax services to continue. So even so, there's continued, there's certain parties that call for the regulatory ban of all other services. They should just be audit firms, and they shouldn't provide both, because there's some problems associated with that. There might be problems with some auditor independence, auditors, it's mostly audit independence issues, but it also could come about from tax issues. And I'm going to be looking at it from the tax perspective in this paper. So the research questions that I'll be asking in this paper, the second item from SOX that is important for my study is the audit committee. The audit committee has an expanded role now. So the audit committee now has to oversee and approve of all the non-audit services that are provided by the auditor. So the confluence of those two is allowing me to do my research here. So the research questions are, is the purchase of tax planning non-audit services associated with firm value enhancing tax avoidance? And what's the audit committee's role in that? Do audit committees influence the effectiveness of tax planning non-audit services? So I'm highlighting planning for an important reason, and we'll get to that in a minute. But the big tension here is that tax avoidance, or either reducing the tax burden or maximizing after-tax wealth, has both a positive and a negative element. The positive element for the firm, not for society necessarily, but for the firm, is a reduced tax burden. That's good. Shareholders appreciate that. But there's a negative side. One, importantly, is the loss of auditor independence. A lot of the research has come from a loss of auditor independence. Loss of auditor independence come from the auditor is auditing their own work when they provide the tax services, And there could be an economic bond. If they provide a whole lot of services, a whole lot of fees are going to come in that may create an economic bond that may lead the auditor to acquiesce to the desires of the client. The other thing that's interesting is the obfuscation of financial reporting. So what Enron did is they set up all these shell corporations, and it was for tax purposes, but accompanied with that, they were able to hide a lot of losses through those shell corporations. So that's part of it. And then also just normal disputes with the tax authorities, penalties, and legal liabilities. So I looked at an interesting subset of firms. We looked at firms that did provide tax services to their clients, but what we did is we dug a little bit deeper into the proxy statement, and we found that about 25% of firms separately disclose whether the taxes that they're getting from their auditor are planning, or consulting, or advice services, or compliance or preparation fees. The planning services are the ones that could potentially help the firms avoid taxes, and they're the ones that potentially are more they're more problematic potentially for independents. But at the same time, it's important to look at both of these because many people think that in order to have a good, effective tax plan, you have to have the write-off of the planner, the compliance, the person who actually prepares the taxes, and the auditor. So having the same group being those three people maybe could have a really effective tax strategy, but there could be an effect on independence and these other issues as well. All right, so I'm going to actually talk about this. So what were my findings? The findings are that auditor-provided tax planning services are positively associated with firm value enhancing, proxy by Tobin's Cube, tax avoidance, when tax planning is purchased in conjunction with the tax compliance. So you have to have, if you just purchase tax planning and you don't necessarily have the buy-off of the compliance, the person who's actually preparing the taxes, then you're not going to be, you might be able to avoid the taxes, but maybe the shareholders won't appreciate it. Also, the accounting firm has provided audit service for at least 2 years, so there's no spillovers. They know about the business, they know what they could use to help avoid taxes, they understand the structure. And most importantly, for my studies, there's accounting experts that serve on the audit committee. So these accounting experts are actually helping in an advisory role. The audit committee is a monitoring board, but a byproduct of SOX, having them oversee this, the tax services or approve them, when there's accounting experts on there, they actually approve better tax services. So what are the implications? A couple implications are that firms and shareholders accrue economic benefits when auditors provide greater levels of tax planning services. So the Treasury Department and the EU are calling for further regulations to get rid of taxes, get rid of auditors providing tax services to their clients. So maybe before they consider this, further regulatory bans or limitations may diminish such benefits. And more interestingly is that existing governance measures such as expert audit committee oversight plays an important role in assisting firms to realize the economic benefits from auditor-developed tax strategies. And finally, this disclosure might be interesting. Only 25% of firms do it currently, break it out between the planning and compliance services, and I think the SEC should consider including that in all firms' proxy statements. So it's currently just a voluntary disclosure. And I guess I can't say thank you. It's not allowing me to say thank you. I do thank you guys, I really do.